This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. My name is Alex Perny, and today we are very pleased to welcome on Gannon with the Largo Group. We're going to be discussing something that certainly gets a lot of press attention, and that's kind of the information regarding short-term rentals. Now, it's easy to kind of identify why they might be attractive to someone's portfolio from a return standpoint. But as we all know, especially as investors, it's not necessarily how much you make, it's how much you keep. And there's certainly a large consideration to the tax planning side of trying to make any amount of revenue, whether that is you working a W-2 job, selling widgets on eBay, or investing in short-term rentals or real estate in general. Taxes are always something that should be a concern to us because, again, making a lot of money is all well and good. But if you're going to be fleeced by the government for half of what you make, well, then you might not be better off than working any job that might be a 9 to 5. You know, the attractiveness of real estate is the flexibility that it offers us as investors to live our lives the way that we want to, affording us a great degree of flexibility and the ability to move laterally and do kind of what we want to with our lives. And again, taxes should be definitely a concern. So Anne, thank you very much for being on with us today. We certainly do appreciate you taking your time. I'd appreciate it if you gave us a little bit of a background about yourself and kind of how you came to be in your position with the Largo Group.
CPA and also the founder of the Largo Group, which is an innovative accounting firm that tries to work more seamlessly with individuals and business owners to make sure that it's not just filing a tax return, but really understanding your tax picture and doing more proactive tax planning. So where we've come into the SDR world is really the fact that a lot of our clients, like you said, find that you're being taxed more and more every year, and really trying to build a better strategy and more diversification. So I think, a lot of the lessons of COVID was that real estate can be a great vehicle to, diversify you, to protect you from these, crazy downturns that happen. And so over the last 2 years, we've really built an SDR strategy to make sure that people understand, what are you trying to get out of a short-term rental? What are the rules for rentals? Because it's really a brand new world when it comes to real estate accounting and real estate tax. It's completely different from traditional rentals, and most CPAs don't realize those differences. Most of it's just a rental, and that's not the case. So we've really been doing a lot in the last few years to just make sure people understand and educate themselves on the risk and rewards of short-term rentals.
Yeah, that's definitely a great kind of place for us to start with. Now, what I might like to look at are maybe pointing out a few, specific items, from the more traditional real estate world, whether it be long-term rental, and again, depending on, and one of the great things and the kind of the downsides to real estate is that depending on the utilization of the property, your tax planning strategy changes wildly. So just because you buy a piece of real estate, there's not a one size fits all, and that certainly plays into the real estate, the short-term rental market. But again, in general, let's just kind of maybe use the compare and contrast model of the traditional rental. Your 12-month plus lease on a single family home. Again, commercial real estate is a whole other animal. But what are some things that, again, just from a high level, that most people are concerned about when it comes to the traditional, again, single family standard leases that people look at? And then maybe let's then in turn contrast that to some of the high level stuff with the short-term rentals, and then we can get into some planning as well.
Traditionally, like you said, you'd have a rental property, you would have a tenant, you would renew the lease every year. And from a tax standpoint, that would really be considered passive, that it would just be this thing that sort of stays on your tax return. Traditionally, in most cases, it's sort of break even because you have some depreciation, you're taking, into the weeds of depreciation, we're taking usually like straight line method over 27 years. And so, at the end of the day, it's probably break even on your tax return. Maybe there's a little bit of cash, but really that is all designed for the long game, right? I joke that whether it's short-term or long-term, some of my happiest retired clients are people that have those real estate because they're really holding on to that for the appreciation that, eventually the rents will be more because of inflation and the property will be worth more and I'll have it paid off in 20 years. And so that was always sort of the game with the rentals. Now, when STR came in, and this is where there's a lot, it's brand new, and it's new to the IRS as well, that, if done correctly, one of the main benefits of an STR is that it can be ordinary income. So that moves it from something that offsets just my other passive income to something that offsets my W-2 wages or all of my other income. So that really can be a brand new world for especially some of your higher income earners, because in the traditional sense, even if there was a loss, in most cases it was disallowed or it was reduced because of income level. With STR, that's not the case. It's considered ordinary. It's really considered that you're treating it more of a business. And the reason for that is it also is a lot more work. And I think sometimes people go into STRs not realizing this, right? There's a reason the IRS is considering this ordinary income. It's because you're answering the phone or you're checking an app, or, you might have 20 people staying in your property in a month, where the, traditional guy has one guy there all year. So there really is a reason why this is ordinary income. But from a tax standpoint, that really opens you up to a much different tax strategy than the traditional. Now you bring in the case of depreciation, you bring in cost segregation, all of these things where you really can impact significantly your current year return. And then, strategically, I've had clients where, they're buying one a year for this sort of perpetual, I'm building my portfolio, I'm building my assets, and I'm, saving my tax return every year. So it's a brand new world. I think what I've seen a lot of times is the assumption of the investor that their CPA understands this. And so many times I've seen a return where it was just treated as a traditional rental, right? Because they don't know. It just looks like you have someone who's paying a lot of money for rent, but they don't really know why, right? So I think that's where there's just such a difference. There, on the revenue that STRs bring in, also the expenses. They have, a lot more expenses because you're cleaning it 3 or 4 times a month, if not more. Your utilities, all of those things, where it really is a business that you're running versus the passive guy who's just paying the rent check every month and moving on. So completely different, but it's something that is definitely worth looking into as an investor, because I think what I like to also educate the STR people on is that as great as it is to get the cash today, right? We want ROI and so throwing in those KPIs that you could do to any business, to your rental. That's all great, but you still have that appreciation piece, right? That just based on inflation, someone's going to pay more in rent 5 years from now. The property's going to be worth more 5 or 10 years from now, even with market cycles and all of those things. Just with inflation, real estate is still the best hedge against inflation, which is so important for those longer term strategies as you're looking at retirement, because you are now in control of your own destiny, right? And that's where I say, I'm dead serious that my happiest retired clients have real estate, because they know their rent's going to go up 3 years from now. They know the property value is going up 3 years from now. And so they just have this comfort level where you're not as dependent on a market and fluctuation and did I buy the right stock or, any of those things. So I think real estate is such an important thing to look at, whether it fits you or not, but just something to just educate yourself on understanding why people invest in real estate.
Sure. I think you bring up a few good points, so I definitely want to dive into a little bit. And it's really kind of the difference in the, the tax treatment, but also kind of, how that income necessarily plays into your broader scope of your revenue streams. With the more traditional real estate, again, 12 months plus a day, however you're looking at it, definitely being considered more in the passive bucket that works to offset all of your other passive income. But, the IRS and most investors understand this. But again, we have plenty of people that are coming to this new. Just because you have offsets, things like amortization, depreciation, expenses. If that's offsetting passive income, that's not going to offset your ordinary earned income to any meaningful degree. What's that current allowance for reduction in that? It's like $2,000. It's like really minimal per year, right?
And it's actually gone down to zero over 150,000.
Okay.
It increased, reduction significantly.
Yeah. So again, it's a good thing to understand, and I don't run into it too often, but it's a very important point because deductions are not necessarily just deductions, right? It's certain things, especially from people maybe getting into real estate, and I think that's a lot more common with the short-term rental game is that people are kind of getting into real estate for their first time, and they might have heard of seminar and learned about it, like, oh well, this person at this place was like, yeah, you buy rentals and it gives you all this great depreciation and these write-offs, and I make $250,000 a year, and I can reduce all my income from being an advertising executive to zero by having all this. Well, it doesn't work like that. And maybe there's some questions I want to ask you to the other side of that with the short term rental game. But again, that's definitely something to look at. Now, one thing that kind of popped into my mind with this is that, with the popularity of short term rentals, and we'll get into, what I just mentioned in a moment, but, you have a lot of, people have been buying real estate. The Romans had real estate, right? It's people have been investing in real estate for millennium and quite literally. Now, from people that, especially with something new, they might be looking saying, hey, look, I live here in Florida. Maybe my part of Florida right now is a little bit of a bad case study because we just had two hurricanes, but, people that own real estate, traditional regular rental are like, oh, well, more people want to move here once we get all the tree debris cleared out. They want to do this as a great place to vacation, especially going into October, November, when all the snowbirds come. Maybe I want to transition to a short-term rental. So I'm sure that probably comes up with, some of your clients of saying, hey, look, I have this rental property. I've been, running it for the past 10, 15 years. Well, short-term rental, instead of getting $1,000 a month, I can get, $1,000 in a week. If I turn this into a short-term rental. So maybe let's look at some of the issues that might crop up from a tax perspective if you have this asset that, again, you might be running straight line depreciation on for a lot of years, and it might be fully depreciated or something. What are some issues that you see with clients that might want to convert an asset to a short-term rental from a tax planning perspective, and what might be some salient tips for people looking to do that?
The standpoint, in most cases, pretty nuanced, but in most cases, it's an average stay under 30 days. Really gets it into a different. So as you get rid of your long-term tenant and you have your average stay under 30 days, now you're really into a short-term rental situation. Now, there's a lot of people also getting into, the 3-month stays, kind of a midterm rental. There's a lot of nuance here because it also depends on how much time you're spending. Is this your, primary focus? Are you a real estate professional? I would keep in mind that the IRS rules for real estate professional is more broad than just a broker. So there's a lot of nuance here, and this is where, like you said, I feel like I'm always fighting the YouTube or the Instagram thing that we watched yesterday because every situation is different. Every single person has a different set of circumstances by property, different set of circumstances by what your income looks like, what your work looks like. So I hesitate anyone to say, I went to a seminar, and I've had people who've told me that, and they have this unrealistic expectation of what an STR is going to do. And I really feel like until you look at your situation, what are you paying in tax right now? Not just what your refund was, but like what are you actually paying in tax? What's your effective tax rate? And based on this specific property, what would the differences be? Because even on the depreciation side, it's great to do a cost segregation or take bonus depreciation. But if you're going to sell the property next year, now you've really created a situation where that depreciation is recaptured back at ordinary income. So in the IRS world, like depreciation, it's supply, right? So whether you take it now or you take it later, that's all strategy. And I think that's just a conversation that you have to have with your tax preparer. Some CPAs hate depreciation because they're always thinking about the end game because it's like, well, if you sell, you're going to have this recapture. That could be true, right? But I think as an investor, you're the one that has to make that decision. You're the one that has to say, okay, this is what the property is. Short term, long term, this is how it fits into my tax picture. And, this is where I want to be, a year from now. But I think when you're going into the SDR side, it really is, it's completely different on both the revenue and the expense. I think people fall in love with the revenue. Like you said, I can make $1,000 in a week and I am just getting $1,000 for a month. That's true, but there's a lot of expenses here. There's, utilities are now on all the time because you have different guests and they don't know how to fix, they leave the heater on, they leave the air conditioner on, right? You have cleaning. You have just like wear and tear on your property itself. You have maintenance, you have issues, right? So it's a huge commitment on the owner side. And so, I think understanding all of that and having a realistic view of your return, because your return isn't the $1,000, right? It's not like, oh, I just have $1,000. Your return might be $100 of that, right? 10% might be your ROI. So you really need to make sure that you're seeing the full picture of what that SDR is. But keeping in mind that it can be done very well, it can be done very profitably, but, just having that realistic understanding.
Yeah, and you brought up a couple other interesting things I never, looked at from, a perspective of kind of, again, my, from the professional side of what I do, being in, clients owning these types of assets through retirement plans and the like, I don't necessarily get too much into the personal income tax side of things just because, it's the nice thing about IRA investing is that you don't have to worry about a lot of that. The extent that I, really get into is, things like sales tax and, some municipalities will have like a local hotel tax that they've applied, especially down here in Florida, where they realized that they were missing out on tons of revenue with short-term rentals because of missing out on hotel taxes and things like that. So, those all have to be considered, especially in the, more in the civilian, quote, civilian side of things outside of the retirement plans. But you brought up kind of an interesting caveat of, what kind of, from the IRS's standpoint, would be viewed in its lease term, right? So, short term from a perspective of things like sales tax, at least where I live in Florida, is anything less than 12 months, right? You might have to pay sales tax on. But that's, local, we have 50 different flavors of that in the United States. So check with someone that's familiar to your local municipality or, just check your regulations. But from the IRS standpoint, you mentioned things like, is it, what is kind of the lease term that kind of gets it out of the passive income and into the more active income side of things? I think you had mentioned 30 days or an average lease term of 30 days or less. So what's kind of the testing period? How do you run that over 5 years? So especially for people converting, is that something we say, oh, well, I have another few years of this still being, passive income before that, or is it every, 12/1 to 12 or 1/1 to 12/31?
It's becoming on the short term work, but how I've traditionally seen it would be the last year. So your most of it in 24. It would be in 24. What's your average lease? But again, that's just one way to qualify for it, because what you're really looking at is the active participation rules, and then whether this is ordinary income as a business. And so, there's lots of other, so especially for these midterm rentals, there's other ways to qualify still, if you feel like it should qualify, which would be, your time investment, are you the decision maker, even things like, are you issuing 1099s, because that's really more of like a business function versus just a passive function. So there's lots of, ways there, but, traditionally I think, the more short term, and again, some of those midterms may qualify. I have a lot of people who do a lot with like the traveling nurses and things like that. But, I think obviously as you get more short term, there is more work, there's more, active participation just because you have to fill the space. So I think really looking at like, would I qualify and does it benefit me, right? Like, am I more beneficial to have active participation or ordinary income? Because if it's profitable, that actually could be a higher rate than a passive rate. So that's where, you really have to know your own tax picture and really identify that effective rate is the most important number to know, because so many times people are like freaking out and then they're in like a 15% effective rate anyway. So it doesn't really matter, right? Because you're still at 15%. So until we know your effective rate, which may be lower than what your tax and wage rate, that's, taking into account all of your tax picture plus your, deductions and your varied filings rate, all of those things, that effective rate is the most beneficial, because then you really can do like a lot on like your side, the IRA investing and the pre-tax, like, is it beneficial to do that? That's where we have to know your effective rate first.
Yeah, that's a really good point too. People get, I think caught up a little bit too much in saying, "Oh, well, here's what the tax rate is." Like, well, yeah, again, that's great, but take a look at the whole picture. How many slices of that depreciation pie are you getting with this? At the end of the day, what's your effective tax rate? Just because you might see 30% tax rate is like, oh, well, I want to be out of that. Well, okay, yeah, I mean, ideally you would like to not be, but at the end of the day, if you're 10, 15, 18% effective rate at the end of the year after you do your calculations, well, that's what you need to look at. Like, that's why there's tax planning. That's why people like you exist. That's why people like me exist. At the end of the day, it's not, be nice if it was that easy with the IRS, but hey, it keeps us employed
No.
and then paying for this internet connection, right? So there certainly is some benefit. Well, there is massive benefit to that. But some things that you kind of brought up there that I think, again, and I'm assuming this is probably definitely one of those, gets really into the weeds, but you said there's some qualifying factors for saying, hey, this is, and is it something where you can like elect it to be? You said there's some things that you can, some things that you need to point out to say, hey, this is, qualifying as active, or if you want to put it in that. So how much leeway do people have to say, hey, I'd like to treat this as active income versus, hey, I'd like to treat this as passive income?
Well, and I think in so many cases of the IRS, it's really just about, what really is it, right?
Mm-hmm.
Like, I don't think it's a black and white thing, but they do give, 4 sets of criteria. I can actually send it to you that people can read it. It gets pretty in the weeds, but I think it's really trying to identify what is it really, right? Like, does it look and smell like it's active, or does it really look and smell like it's passive, based on these 4 criteria? And I think some things to consider, especially, is owner involvement. Because even, a lot of people have heard, well, that wouldn't qualify because I have a job. Well, your job is 40 hours a week, but if you're, checking your phone all the time, if you're the one who answers the call at 1 a.m. when the air conditioning breaks to get the repairman out, right? Like, so that doesn't necessarily disqualify you. That's where you really, but at the same time, if you have the job and you have a property manager and you're really not making those decisions, you're not answering the call at 1 a.m., you're not doing the booking, you've handed that to someone else, then maybe it really is inactive. So that's where, again, going back to what is the truth behind all of these, different factors, I think that's really what you want. And I think, like you said, you really want it. I mean, you want it to be something you're comfortable with long term. You want this to be part of your long term strategy. So, again, all the people on, the internet people who love to give tax advice, that's a very like quick, like, okay, we're done. But what we're really trying to do is build a long term strategy, to build your portfolio in real estate and build your investment and your, net worth. So I think we want to make sure that we're comfortable with this and this really is what it is. And if it's not, it's okay. It just changes our strategy, right? So I think that's where it's not a right or wrong or good or bad. It's just, what is it really? What is your involvement really? And what does that do to our tax picture?
Yeah, you bring up a kind of a funny point. It's like the internet talking heads that it's like, hey, I'm not giving tax advice, and then proceed to give tax advice.
Oh my God. It's terrible tax advice.
Sometimes I hear this and like it's like, oh, it's like this isn't tax advice. I'm like, no, that was tax advice. 100% was tax advice. Like you're telling me you gave someone an actionable item that can affect their taxation and told them it wasn't tax advice. It's tax advice. Like, anyways, but that's a whole other issue I have with things
The
in the
internet.
world and everything. Um, so again, yeah, it definitely kind of again, and that's really interesting that you bring that up. Is that it's nice that the IRS gives us some leeway and doesn't make it as black and white. And again, one of the nice things about real estate is that it can be, as active as you want it to be, and you could certainly have an active long-term rental business. It's definitely something you could do. Again, it leans typically, well, it depends on how many you own. It depends on kind of the state of those properties. And it also kind of, it depends on, again, how active you want to be with it. And again, the short-term rental stuff, I would honestly say maybe gives you, a little bit more of an avenue to be passive almost, especially, it's, there's a little bit more of an ecosystem, I feel like, around the short-term rental market for the property manager side of things where you can, the market is kind of, matured to the point, at least here in Florida. Again, it changes every location, but at least here in Florida has, we've had a good basis of short-term rentals for a very long time. Places like, maybe your Nashville or Memphis or Austin, Texas really haven't had those kind of things. Everyone wants to go to the beach for a week, right? They come down here and that's been a very common thing. So depending on where you're at, the ecosystem for, the management side, There's, excuse me, definitely a pathway forward for that. Now, one thing that kind of, crops up a lot is, from a tax planning perspective would be, entity structure. Very few people of these are just buying things in their personal name. And, the beneficial structures for one certainly aren't necessarily always the same for others, and there certainly is some overlap and some bleeding of those lines. But in general, kind of, what do people, again, this is one of those ones where it gets into tax advice real quick, right? Especially when we're talking about entity structure. But what I like to kind of phrase the question is, and I've done this a few times, is things that people should, kind of do some more research on. Are there things that are basically in general maybe not the best fit for people, or are there some things that are saying, hey, look, in these changing structures, depending on again a whole bunch of other factors that really bear more intensive research on the side of the client. Our S corps maybe not always the best fit. Again, they certainly could be. Are maybe looking farther into having a C corp for something, and maybe being able to shelter things at a corporate level if it's really active. If you're going to be claiming it as W-2. So what are some things again, high level? And again, I make this point about like, hey, this isn't tax advice and giving tax advice, but again, high level of things that bear more investigation by people that might be different from the more traditional world of real estate.
Yeah, no, I'm glad that you brought that up because I think that's the other big difference that I see between the short term and the long term is the level of risk, right? So if you're long term and, maybe it's probably just your personal name, you kind of bought it on the side, you have one guy in there all year, like there's not a ton of risk, right? Like you're getting mailed the check, it's, pretty informal, like you have a lease in place, and, but of him slipping and falling, you're okay, right? When you get into short term, now you might have 10, 20 people in your property a month. And so there's a huge level of risk that goes involved. So what I've really seen a lot of is, people really moving the entity structure, the property ownership into LLCs, just making sure that there is some level of protection, really knowing your state rules for if somebody, does have a claim against me, does the state release the information? So yeah, I'm not a lawyer, but that's definitely what I've seen is some people being more aware. Now, the downside of that is that really puts that into, most cases a partnership return. So on the tax side, employment income potentially, like there's, different tax rates. The other downside is if it's owned by an LLC, it can't be an S corp because S corp has to be owned personally. So from a protection standpoint, the S corp doesn't always work because it's just owned by individuals, and if you're trying to kind of shelter some protection against the individual, that may not work. Which again, I love the fact you brought up a C corp because I joke that I'm like the only one who loves the C corp because most CPAs like hate it. But I really feel like it's not a bad structure. I know there's the taking money out and the dividend, but from a protection standpoint and tax rate standpoint, a C corp is a great vehicle. Just to make sure that assets are just in one place, protected, no flow throughs. It's not going to different people's tax returns. So I think ultimately C corps will become more of a conversation, especially as we get into 25. There's talk of qualified business deduction going away. It actually does go away in 25 if they don't do anything. So I really think that C corp will be something people talk about more. But I think what I like to say as entity structure is just what is your end result, right? Like what are you really trying to do? Is it something that you're going to own forever? Kids? Is it something that a group of people put money in and they're going to take money out? Like kind of knowing the exit plan first really helps with answering some of these questions, and then also just being aware of risk.
Sure. Now, excuse me. You bring up exit plan, and that's not necessarily something that I, really kind of comes across my, thought process too much. Again, kind of being a moot point for a lot of people in the, you know, the tax qualified entity world of investing, because you're looking more just towards what are the rules for the IRA or the 401k or the defined benefit plan more so than like, okay, what are the corporate rules necessarily? But when it comes to kind of in goal plans, what are some things that might factor into again an entity choice at a high level? Because again, that's something I've never really heard about. And again, if that gets too far into the weeds of being advice, let me know. We can skip forward.
Well, I think a lot of what I see is like the trust idea. Like if you're going to buy a piece of real estate, are you, is it eventually owned by a trust? Is it just owned individually? And just really thinking of some of that succession, really long term. one gentleman who bought a bunch of rental properties over the last 20 years on the Outer Banks. He just keeps buying property. They were cheap. Now they've gotten, a little less cheap. He just sort of knows what he's doing and has a great business. When he did the math, I mean, his net worth is substantial now, right? Where like it really wasn't 20 years ago. It's just the appreciation of the properties, times 10 or 20 or whatever it is. And so all of a sudden it's like, well, these are owned by just, him and his wife. So like what happens with it? Like, should it be more in a corporation, right? Like that maybe there's shares. That's where a C Corp really could be beneficial because it's just all in the corporation. He has the shares now, but he can transfer shares to kids as they get more involved, right? Does it just go as part of his estate and it's just going to become what it becomes there? So, that's kind of what I think is important to think about, and that will sometimes guide, how complex do you need this to be, right? Because right now it's kind of sitting on his individual return, and that's fine. But, what is sort of the end game? And I think in real estate where it becomes interesting is, and this is true with business owners too, is that, you bought it for X, but it's worth substantially more than that now. So this appreciation really is nowhere to be found on your tax return or, even in your balance sheet, right? Because it's cost basis. So like you're the one that kind of needs to know what your real net worth is, because it's not on your tax return. That's just that, you paid $100,000 for this property 20 years ago, $100,000, right? But it's really not $100,000. It's probably like $700,000 now. So that's where I think some of these things that are good to think about in entity structure are important, because you may be bigger than you think that you are. Sure. So it may be more complex than you think.
And that's kind of an interesting kind of higher level point that you brought up, is that entity structure has a lot to do with kind of long-term planning of, continuity of these assets for your heirs and, your long-term goals, in conjunction with, a tax planning strategy. I always think more towards the, immediacy of these things of, okay, what's your, liability exposure? Why are you setting up this entity? Outside of it, also like, do you want this stuff passed through to your personal income tax return, or do you want it hitting, something like a C Corp, in that regard? So again, looking at it from that perspective is definitely interesting. And one anecdote I always put to people, especially, real estate, good, bad, or indifferent, first and foremost, I always tell people, especially when you bring up the point of liability, and this has to do with, the IRA side of things versus personal. I always encourage people to talk to a living, breathing person when it comes to underwriting your insurance. Yes, you can use an online tool, but insurance companies, and we see this all the time in Florida, they're interested in not paying a claim, and you don't want to get stuck with that. So talk to someone, make sure the stuff's underwritten properly, make sure you take a look at your values of your property, and if you're doing, replacement cost versus, asset value replacement. Like, there's a lot of things to look at, and having someone, again, can you do your taxes with, TurboTax? Sure. Can you just open up an IRA and with Fidelity and buy some stocks? Absolutely. But having people that have done this and have some expertise and some knowledge behind it is very beneficial. And especially when it comes to, owning properties, the first thing that they're going to do is look for the insurance, right? If your entity doesn't have any insurance, but you have all this huge complex, paid tens of thousands of dollars for these entities to protect stuff, well, that, might as be good as the paper it's printed on. So again, talk to an insurance, someone that's done insurance for a while, that understands the investor world, and can really help you out. And also, second to that, liability typically flows down to your particular state, with regards to entity structures and stuff. For instance, in the state of Florida, typically single member LLCs don't offer, typically are treated as a pass through for liability issues. So, making sure that, hey, if I need to have that liability protection built in, making sure you have something like a partnership or whatever your state looks like. Again, I always encourage people to talk to experts, talk to an attorney. An ounce of prevention is worth, metric tons of cure in this world. So, just talk to people that are experts in these fields. But, I digress a little bit, because those are slight passion points of mine, because I deal with those questions constantly. Into, again, the things that, again, I find C Corps interesting, one, because they have some really interesting utilizations in the IRA world with shielding people from, taxes like UBIT taxes for business ownership, and also unrelated debt finance income taxes for debt leverage things in IRAs specifically. So there definitely is some cool use cases for some really exotic taxes that I find C corps to be interesting for. But not to get into that, because I literally teach like an hour and a half course on those taxes. But from the perspective of this, it really kind of brings up an interesting point, of that, people always kind of shun the C Corp for a lot of things. But like, oh, well, if my whole point is tax mitigation, why am I just automatically electing to be taxed to bring in a whole new boat of taxes to myself? But at least from, and again, I'll kind of put this out there because I always like to have my ignorance corrected because, always good to learn. But I would think, at least from a standpoint of something that's going to be active, having something where you can take advantage of all the things that are in the business world, because that's what corporations are for, active earned income and all the deductions and write-offs that are attributable to things that are more active in nature. Your oil change place in the corner is probably a C corp because they're employing employees. They have, active stuff that's going on all the time, so the government's giving them deductions that are specifically focused towards writing that off. So especially in the short-term rental world, I would imagine that there is maybe a greater propensity to have stuff that's going to benefit you at the end of the day to get that effective tax rate as low as possible with the C corp, while maybe not as pronounced with other entities. Or maybe there are, and it just kind of depends on what, not certainly always going to depend on what your end goal is, but maybe kind of elucidate more to that of what you see as some of the specific benefits, since you said you like the C Corp, of why that maybe plays into the short term rental market well for people, all else remaining equal.
Yeah, I think that even it becomes secret becomes more beneficial as there's more income, so as your portfolio gets bigger. At the beginning, it probably does make sense to single and LLC is return. But I think it's also about as you get more complex, a C corp, it just becomes something that it's easier to manage it as one final number, and the C corp then pays the taxes itself. So I think and this is true for businesses and rentals, where it gets difficult is the understanding of the flow through, right? So if the partnership makes 30 grand, first of all, you're taxed on that 30 grand whether you took the money out or not, and that can be difficult at times because you may be investing in a new property, right? Like you really don't have 30 grand cash because you're paying down a mortgage, or whatever you're doing, and now all of a sudden the owners have 30 grand, maybe it's 30 needs that they have to pick up on their individual return at different rates. How do I know what this really costs? They had one that was like husband and wife, and the husband's business did great, the wife did terrible. She's like, well, he should owe because mine had the loss. So like even on a married filing, certainly there's those situations, and it just becomes very hard because it's apart from what the cash is, right? I think similarly, a C corp, what I think just especially when you have multiple owners, becomes very easy, right? The business made 30 grand, we're taxed on blah, 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 and the business is not going to pay it. So that's some of why I like a C Corp, is just because I'm sure you have things that you're always dragged into. I'm always dragged into the, why do I owe on my personal return? Well, you have a K1 that has, 40 grand of income. Well, I don't have 40 grand. I don't know. Like that's what it is. So, whether it's a rental or a business, that's where it like have to have awareness of what is the structure. Are you taking a distribution? Because on the flip side, so many owners, even of real estate, think, well, I'm taxed on my distribution. No, that distributions is just your decision to take the money out. You're taxed on that net income if it's a flow through. So we just have to build that out. And that's where, C Corp might not be perfect, but it does clear this up when you have multiple owners, because it puts it just on its own. That's a C Corp tax. It pays its own tax, and the owner just continues on regardless of what happens. And if they do get money out, that's really the only time it affects their return. So yes, technically there's a double taxation, but it really is much cleaner because they're only paying tax on the cash they actually receive, and usually at a lower rate.
Well, that's really kind of an interesting point you bring up, and it was kind of antithetical to my thought process. Is that you're saying it's more towards like the size of like the operation, really. If you have multiple owners, if you have a ton of properties, and you have a lot of things going on, the C corp works well for that because it helps to clean up a lot of things. And what I'm kind of hearing from you is that the perspective of like how you can claim deductions and what kind of flows through and help to mitigate those taxes can kind of be accomplished with really any of these structures as long as you have proper tax planning in place. But the benefits to maybe going the C corp route are more to do, at least from your perspective, are more to do with like size of ownership groups per se. Is that fair enough to say?
Complexity, I think as you get the bigger bottom line, what I see a lot of times is just piece becomes more of a burden, right? Like obviously you owe more in tax at the end of the year, you have multiple owners who make rates, and so if not done correctly, you end up rushing to do the tax before March 15th. I don't want to go on extension. I just want this done, and all of a sudden you created a tax liability for the owners, and they don't even know it yet, and then they file their return, and everybody's angry at each other. So I think regardless of what entity you have, I think that's where you really have to look at it in the current year before 12/31. What's our taxable income? If you have multiple owners, have we, written off what we need to write off? If we have mileage, all of that really should be cleaned up before the end of the year. And then, from a cash flow perspective, if we each have 30 grand that we're now picking up on our K1, are we taking a distribution for this? I think this is, to me, is the biggest lesson of like the last 5 years, not to go too in the weeds of COVID, is that so many times the business owners, the real estate, they're all looking ahead. And it's like, I don't want to take cash out because I need that a year from now. Well, that's great until a year from now, something happens, hurricane hits. Like, so, to me, you really should be taking that money out because that is yours, right? And the business should be able to generate another 30 grand next year and plan on that 30 grand. And if we can't, then that's probably a planning conversation we need to have. But just leaving the money in, if you're claiming the income on your return, really only hurts the owner. And it's not you being greedy. It's just, if you have a W-2 job, you're getting paid every 2 weeks, right? So like, if you're claiming 30 grand on your K1, I think you should have the 30 grand in your hand. And that's just, I think, good for planning because now you can turn around and invest that 30 grand. You can do something else with it. But if we just leave it in the business and we forget about it or just paying taxes on it, I think we're hurting ourselves as the
Yeah,
owners.
absolutely. And especially for those people that kind of, to go back to the beginning part of this conversation, that, the attractive piece to this might be the aspect of saying, hey, I make a lot of ordinary income. Well, if I can have this thing on the side that's going to pass through and help to offset that ordinary income, and like you said, the cap now is you can make over $1.50, then you get no offset from your passive stuff to the personal, and it was minimal to begin with anyway. I mean, something's better than nothing, but in the grand things like the couple grand right it's like, oh gee, thanks. So again, I always thought that bleed over was kind of pointless anyway. It's like, what's really the point? I mean, the people that it would affect probably would have no passive income anyway. It's like, okay, you make 50 grand a year. I mean, again, and this is just kind of a statement of fact. People that are making that amount of money, again, there might be some people, that only show 50 grand on the books. They have other things going on, but in general, the large part of the population, if you're making $50,000 a year, probably don't have any appreciable, passive income that's going to offset that. Maybe $100 or $200 a year in interest. That's being generous. For what banks are offering on interest for basically any type of cash account. But again, it just never really made sense to me. But I digress. So again, the pass through models again, aside from the C corp, can offer that flexibility if you are passing through this active income to yourself and you're still working. Which again, I think generally people are trying to only do real estate, so maybe you don't have as much that W-2 stuff. Of all the Instagram and TikTok people, that's the goal, right? That's what you need to do. Where reality differs from that is quite stark. So again, that's definitely kind of, definitely something to look at from that perspective. Now, kind of getting towards the, end of this interview, what I'd like to, kind of pick your brain about a little bit is, things that might be changing. The tax law is anything, it's very dynamic, right? Every single year we get a multitude of updates, and it's, we don't know what we don't know and see how they apply. But is there anything kind of on the radar that, people should kind of be cognizant of coming forward into 2025 that might affect a decision or might affect them if they're doing something with their taxes, especially as it relates to short-term rentals?
Yeah, big one is the depreciation rules. We've been on a sliding scale for the last 2 years. You are aware that, we had 100% bonus depreciation, which meant, in certain categories, your equipment, some of your shorter term or your shorter life assets were able to take 100% bonus depreciation. So if you bought, a property and it had, a shiny new oven or whatever, that oven could be taken at 100% depreciation. And that's where a lot of these big write-offs came from. It's just that this 100% was there. It was 80%. Now it's gone to 60%. If nothing changes next year, it goes to 40%. So a lot of your bigger investors, even some of our like bigger real estate guys are like, I don't know if I'm going to do anything next year if it's at 40%, because that really starts to change your, cash outflow versus, some of these big tax savings and all of that. Still doesn't, still may be a good long-term decision, but definitely something to really look into, because that would change. Now, they could change that, assuming they do. So that's not necessarily, etched in stone. But if nothing's done, it would go to 40% next year. The other big one to really keep in mind, and this is for, a lot of the business owners, but it's also the real estate owners, is the qualified business deduction goes away. So if you are, in the short-term world, it's active participation or it's an ordinary income, but also if you're just, a business owner, chances are you're getting this qualified business deduction, which was written to level the playing field between the pass-throughs and the C Corp. So the main difference is the C Corp is a permanent change. So the C Corp is at 21%, and unless they change it, that will always be at 21%. Qualified business deduction after 25 goes away, which means that now all of that business income goes back to your ordinary rate. So if you're in like a 32, 33% ordinary rate, that business income is now taxed at 32%, 33%, whereas now it brings it down to 25%. So you really could have a significant tax change. And if you're ever looking at your individual return, it actually has a line that shows you the income reduction you're getting for the qualified business deduction. And it's significant. And so that's the biggest one where I think it will force some of these business owners to think about diversification. What else should I do? Because if nothing's done, that's going to be the biggest hit to anyone who's, business owner, pass through these K1s, all that. Like most of them are having cost of business deduction. And so that's really going to be the one that will probably start the conversation of what else can we do? What should we diversify in? That's where passive may become more attractive, because that is a different rate potentially, as well as like.
Yeah, no, those are some definitely great points. And I didn't necessarily, I knew there were changes to the bonus depreciation, but I didn't realize it was going to be that significant. I mean, 40% depreciation is, I mean, that's again kind of, again, I feel like like that only really does to hurt, like, people, the big kind of thing of there's like, oh, these properties aren't great that people are renting and doing this. It's like, well, give the business owner the incentive to make some of these improvements, repairs, and things for the property. And if you're dropping it to 40%, well, like you said, you have a client that says, hey, like, well, if I have three properties that all need, a new fridge and stove, well, it's like, hey, they work. Well, let's wait till we have some, more flexibility for that to do it. So again, we can, maybe not the best place to offer opinions on things like that, but again, it's a practical application of, what tax code has direct real world implications for how things operate, especially when it comes to housing. Acquisition, improvement, repositioning, all these things play in, at the end of the day, people, again, you're going to do what makes the most sense and, generates the most revenue. And if that doesn't, then, well, it's not going to happen. One thing I did have a question though on that, I do a lot in the, commercial real estate side of things. And when it comes to at least single family homes and, again, by extension, single family rentals, when it comes to taking that kind of depreciation or bonus depreciation on individual items of a particular property, does it have to be a newly, like, does it have to be a new item that's put in, or is there anything where you'd have to do something like a cost seg analysis for an individual property to be able to take that? What's kind of again, hoping that it doesn't change, what are kind of the mechanisms for making sure that people maximize the ability to claim those deductions on things for properties?
To be new, there are two different bonus, the 179 and then the bonus depreciation. So it doesn't have to be new to get accelerated depreciation, but I think what you're really doing is identifying. So a lot of what cost segregation is, if you go buy a property, you're not just buying a property that's going to be 39-year useful life. Because again, if you're in this active world, it actually goes from 27 to 39. So that's a long time to depreciate properties. If you buy a house for $200,000, you're going to be depreciating it over 39 years. Now, what I've read, and I've done a lot of reading on this, but a lot of, the traditional of where this bonus depreciation came from, or, the accelerated, all of that, is really starts with identifying the assets and saying, what assets aren't going to be here in 39 years. Like my light fixtures probably aren't going to be here in 39 years, flooring, right? So that's really what you're doing in a cost segregation, is really allocating your purchase price to the separate and identifiable assets. And, if you think about it, that really is, like that's saying that, my light fixtures are probably going to last like 5 years, right? Maybe 10. My SDR people who flick the switch all the time, maybe 2, right? So they're probably not going to last 39 years. And so, I think when you read about it, this is where I think the internet has gone crazy in what cost segregation is. But that's really where it starts, is allocating the cost to what you're really buying. And then from there, deciding. Now, I've had cases where doing any accelerated didn't really make sense, because the other side of it would be, if I know this property is going to be a home run, right? It's Key West, Duval Street, whatever it is. Maybe I don't want to take all the depreciation in the first year, because over the life of the asset, I might want more residual depreciation to offset that income every year. So from an IRS standpoint, that's where, depreciation is not like you're winning over the government, right? Like you're either going to take it now or you're going to take it later. And when you sell, they're either going to have it back or they're not. So it's all a timing sequence, but you really have to really dig into depreciation to understand what are your goals for the property, what is the allocation of the cost of the property. Obviously, new has more to allocate because there's more value in the flooring, there's more value in the new appliances, like all of that. But ultimately, even if it's new, it may not be beneficial to take as much if you know the property is going to earn more money in future years. You really are just paying it right back next year because you took all the depreciation this year. So it really is a very nuanced thing that I think, the cost segregations can definitely help, because that's someone who's really going in and doing that research and doing that, independent evaluation. But ultimately, I think the investor has to understand, like, what is depreciation. It's not just like, I won against the government, right? Because next year you're going to have more taxable income because you have less depreciation. So
Yeah,
we just need to understand that.
And again, it really plays into strategy. And that's, again, kind of the part of the issue I see, at least with the large amount of people kind of coming into this space new and doing, I call it research, but again, like, hearing what the talking heads have to say of, what makes sense for commercial real estate, that's where, kind of the buzzword kind of came out of, people look, it's like, oh, well, I can do all this. And I'm looking at this and look at all these great returns paid out on K1 and all these, pass-throughs that are given out to these people, and cost segregation. I don't know. I wish I knew how many times I've heard that word in the past 4 years. Um,
You don't even understand what they're doing. It's just like,
yeah.
I know.
But the interesting thing is that, it at least in my mind, it never really made, I mean, everyone, your mileage may vary. Every investor is different. But again, typically for my clients that were, holding, long-term rentals, it didn't make a whole lot of sense to go through the expense and do a cost seg analysis on, 3 rental properties. It's like, okay, well, these expenses are going to come up, and when I have to replace it, I can write off the expense, but do I need to necessarily depreciate that that particular item over a different scale than the rest of the property. I can just do it over the 27 years and be happy because I'm going to be holding it for 30 years anyway. It's just those kind of the difference in looking at this as, yes, it's real estate, but it's a whole other animal. Just like single family rentals is its own thing, commercial real estate is its own thing, raw land, ag, all different stuff. I really feel like the short-term rental needs to be looked at, again, it needs to be segregated from the regular rental market because it's a whole new thing. And just like we've been talking about for the past hour, it has a whole other, slew of things to look at when it comes to a tax planning perspective. But again, that's kind of interesting where I think there might actually be, especially for the short-term stuff, a benefit to going through that. And again, depending on how many properties you own, because cost segs are expensive, or they're coming down in price with the more people that are looking at it on the residential side. But again, that's certainly something to look at. And I think that the buzzword maybe holds some water, especially looking at the short-term area. But, with that said, I think we've definitely kind of covered a lot of great information. I always like talking to people that like to, get into the granular aspects of the tax code because that's where I like to live as well. And especially kind of covering, some of those things that are coming up in the future with the qualified business deduction as well as the bonus depreciation changes that, and correct me if I'm wrong, there are still some things that might change with that. We don't necessarily know what's going to come next year.
The permanent changes corporate for the 21%. Everything, a lot of these rules are all under things that they could change it. I know there was a lot of changing it even this year, which could happen before the end of the year. So to keep in mind, the IRS loves to make decisions. I mean, they could as late as like November 25 change it and make it retroactive back to 100%. Mm-hmm. So they can change it at any time, but I think strategically it's just good to be aware because, historically, if every year is 100% bonus, it really wouldn't matter when you're buying a property if you buy it this year or next year. But, if we know it's going down next year, it may matter if you buy it this year or next year, mm-hmm. Depending on what you're planning on. So, I think it's just something to be aware of, plan worst case scenario, and, in the event that everyone gets along, which probably won't be the case, we could have new tax rules.
We're going to hope that everyone in the government gets along. Well, okay.
Not going to happen.
Well, anyways, I really do appreciate your time today. It's been very engaging, and I think we got definitely some great content for our listeners, and hopefully they, learn some stuff as well. And as I do with all of our guests, if they have something they do professionally, I encourage my listeners, if you're interested, certainly to reach out to them directly, to engage them for legitimate advice and planning and things like that. Because again, take this with, take any podcast with a grain of salt. All of this stuff when it comes to what you are doing personally, really should be looked at by an expert. And you should engage them professionally so that way you get, good advice. Anything in life that's, good has value. And again, you should, there should be some exchange there, right? So, place the value on that because again, the nominal fees that you might pay up front is going to be worth, again, metric tons of cure in the end if you, do it right and never have an issue. So if people are interested in reaching out to learn more about what you have going on with your tax planning practice, how can they get in touch with you?
Webinars and education sessions on some of the short-term rental stuff going on, or they could, send me an email at agannon@thelargogroup.com.
All right, fantastic. Well, again, Ann, thank you so much for being with us today. This has been another edition of the Alternative Investing Advantage podcast. My name, as always, is Alex Perny, and thank you for joining with us.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.